In the 1990s, he created $1 billion copper producer. In the 2000s, he launched what would become one of the world's top primary silver producers. And in 2015, he started what he believes will be his third billion-dollar company. This is the one gold stock to research right now. Visit futuremoneytrends.com/investright. Greetings and thank you for joining us at futuremoneytrends.com. I have a special guest for us today. He's really the only economist out there that has not groundbreaking, I guess, but the real data. It's so funny, people, I hear all the time, they go, oh, Trump doesn't know what he's talking about. Or, a commentator, like a guy like Peter Schiff doesn't know what he's talking about. And then they use the BLS, the government unemployment, the government inflation as their evidence, when in reality, it's so skewed, so manipulated, and so far from reality. I'm so happy to have with us today John Williams of shadowstats.com. I highly, highly recommend everyone get a subscription. It's very reasonable. You'll know exactly what's going on. It'll give you an idea how to adjust your portfolio and how really, when you're looking at how you plan things in your own life, it's good to know what's going on in the economy. John, thank you so much for joining us.
Thanks for having me, Daniel.
John, let's start right off with this recent decision by Britain to leave the EU, Brexit. How is this going to unfold, in your opinion? Is this going to eventually lead possibly to the end of the EU, maybe even the end of the currency?
Well, it could. The circumstance with Britain, as it was explained to me, and I gather this was not an original quote by my friend, but he said the British basically had agreed to join a trading bloc. They weren't looking to join the Holy Roman Empire, and that is the European Union was set up as something that eventually would become a sovereign state taking over all the member countries. Big problem with that, because you have a very diverse countries involved there, and a lot of them joined the currency union. The British joined the union, but the pound. They didn't join the euro. But Germany, Italy, France, among others, all joined within the euro. Now, the problem there is that in order for that to work over time, you have to have consistent policies within the government and fiscal policy, in particular, so that all the countries are operating in the same direction. Anyone who thought that the Germans and the Italians could ever reconcile fiscal policy either didn't know the Germans or the Italians very well or didn't care. I think it's the latter case. I think this is more of a political move to set up this trading bloc than to have something that would last forever as a new political union and currency. You've seen the circumstances with Greece, and there's been ongoing talk about maybe the euro breaking up or being reorganized. I can't see it holding together. Nobody's willing to give up their sovereignty. That's what the British were fighting. It wasn't so much the trade issues, although there were trade issues there as well. But they weren't. They couldn't see giving up their sovereignty. It's not. What I think is going to happen is that you're going to see a dissolution of the euro as we know it, a reorganization to the extent that they reorganize it, where countries that have similar policies might be grouped into, a more conservative euro or more liberal euro in terms of fiscal policy. Then you wouldn't have the battling back and forth that you've been having, where you can't hold the Greeks in bed with the Germans. It's just a physical possibility. So What has happened with the Brexit is that it shows you can break away. It's already triggered a lot of movement by other countries to have their own referendum to possibly exit the euro or to exit the EU. The other countries all are generally members of the euro. So if you have a member of the euro that does move to exit, that's going to force a reorganization of the euro, and I don't see it being reconstituted at anything close to where it is now. Over time, whatever happens, I'd follow Germany. They have very strong economy, strong trade practices, a very good fiscal control, and the best control of anyone in the system there. So I would look for wherever the old Deutsche Mark settles, and any kind of a new euro as being the new lead currency, not only for Europe, but possibly for the world, because the dollar is going to have ongoing problems.
John, with the problems in Europe and the potential systemic risks with the EU and the currency itself, is this a potential lifeboat for the U.S. dollar?
A lifeboat for the U.S. dollar?
Yeah, because if Europe is falling apart, I personally would think that investors, first of all those Westerners in Europe, are going to flood into Swiss francs and U.S. dollars.
Well, the interesting thing is that you did see, with the Brexit vote, you did see some flight to the dollar. There was no flight to the Swiss franc, but the Swiss have been trying to peg themselves to the euro for trade purposes. Not a real good idea long term. There's no reason that the Swiss can't continue to be independent and very, very, very strong. It would help them if Germany broke away, which Germany's not going to do by itself. But if you end up with a German euro, the Swiss would tend to float closer to the German euro, be a stronger currency. What you saw the flight to, though, beyond the dollar, was number one to gold. Much stronger flight to gold than to the dollar. I mean, to it, gold, which is denominated in dollars, rallied sharply in dollar terms, and some flight to the Japanese yen. Japanese yen also rallied sharply against the dollar. So the flight to the U.S. dollar was not the primary target, although it was a major one with the Brexit vote, and as better alternatives come along, such as a restructured euro that actually is sound with strong economies behind it, strong fiscal controls behind it. I would see that and the Swiss franc being the dominant currencies. The other area, of course, is flight to gold. Gold is your long-term hedge against all the currency foibles that the system's been hit with over the millennia.
John, the Federal Reserve said that we were going to see 4 rate hikes over the next, I guess we should be already experiencing them in 2016 and early 2017. They've delayed. They keep baking it in the cake that it's going to happen. And then, of course, just 2 weeks ago, they delayed again, kicked the can. What state is the U.S. Federal Reserve in? And I'm going to throw it up there like this, and you can give us all the details and fill it in. But are they clueless? Are they just mismanaging it, or do they actually believe that they could raise rates in this environment with indebtedness and the U.S. stock market essentially completely dependent on these artificially low interest rates?
I think they're playing games, and I think they've got an extraordinarily good idea as to what's going on. In fact, I think if you go back to the last meeting they had, and Janet Yellen's humming and hawing after that and indicating it's going to be some time probably before they actually did raise rates. I mean, backing off all the earlier hype about raising rates. I think she had a pretty good sense that Brexit was coming. There were polls out there that showed it, and beyond all the hype. And it's the problem is It's a problem for the Fed, and it's a problem for the other central banks. The system effectively collapsed back in 2008. The banking system was on the brink of collapse. And when they said, we've got to get all this bailout package passed or the system's going to collapse, the banks are going to fail, they weren't kidding. They shouldn't have gotten to that point in time, and I will very strongly blame the Fed for, particularly the Fed back in the 80s and 90s, for being in that circumstance, and the federal government, the way it ran its policies. We shouldn't have been there, but do you let the system collapse? No, you don't. So what they did was they took whatever emergency stopgap measures they had to take in order to creating liquidity, bailing out entities ranging from large banks to General Motors and AIG, to guaranteeing all deposits. Whatever they had to do to prevent the system from collapsing, whatever liquidity they had to provide, they provided. The only thing they didn't do, although they bought some time going into the future, was they didn't do anything to address the underlying fundamental problems of the long-term solvency questions of the United States, which remain, and what was obviously a very weak and collapsing economic circumstance at the time. You can't contend the economy never recovered. I mean, there may be a little bit of bouncing, but generally it was stagnant post-collapse into 2009, and now it's starting to turn down again. And the Fed and the other central banks did everything they could, but they don't know what to do now to prevent a collapse. We're seeing the second leg of the panic of 2008 effectively beginning to unfold, and it doesn't have a happy ending. They have no way out of it, so they're playing games. What the Fed wanted to do, one of the key things in all of this, which is sort of a flip-flop of what had happened before, was they wanted to have a strong dollar so that it could draw some capital in from abroad to help support the system, help support the banking system. The Fed's primary concern here all along has been to keep the banking system afloat. The U.S. economy, there's not much they can do for that. They admit that. All this quantitative easing has all been aimed at helping the banks. The problem with the higher interest rates was that they viewed it as a negative for the economy and a negative for the stock market. And there might be some issues there. I think actually higher rates are probably better for the economy. There's some complexities with that. But all the talk about raising rates, and this went on for a couple of years.
Yeah.
The rumors, we're going to raise rates. The economy's too weak, we're going to pull back. No, we're going to raise rates. They actually increased rates a quarter point back in December. But beyond that, everything has been talk and hype. It's been nothing but a mind game trying to support the dollar. Because if you're trying to support your currency, one of the fundamental things you can do is raise interest rates against the rest of the world. That will tend to draw in foreign investment, foreign cash into your markets, and support your currency. We saw that starting back actually in July of 2014. Part of that was tied to the Russian circumstance in the Ukraine. The administration wanted to impose financial sanctions. They didn't do it formally against the government. They did it against some of the leading government officials. But coincident with that, and there's been a lot of talk, and the Treasury's actually admitted to having launched some financial wars before on a political basis. The effort there was to drive oil prices down and to strengthen the dollar, which would all of which would have negative financial impact on Russia. Russia playing around with Ukraine at the time, and there's a direct inverse relationship there with the dollar. The dollar's strong, oil prices tend to weaken. Oil prices are not denominated in dollars. If the dollar is weak, oil prices get boosted. And that's why you saw the drop in oil prices this last week, as there was some flight to the dollar, and the dollar strengthened. But now with all the Fed push through, now they've got themselves in a circumstance and say they want inflation. Well, to get inflation, the best that they have is to lower the dollar. That'll spike oil prices, and that'll give you a quick boost in inflation. But the system's not stable. Their primary concern, again, is the stability of the banking system, not the economy. There's not much they can do with the economy. And I think they're looking at some serious problems, not only in the U.S. banking system, but also in the global banking system. So the central banks here, they just don't have a way out. They never figured out how they were going to get out of the crash back in 2008. It's still playing out. They just don't know what. They don't have a solution that provides them with a happy exit.
John, with the U.S. election coming up, the general, I mean, it's quite a time here. You have basically two anti-establishment candidates, Donald Trump and Gary Johnson, although Gary Johnson doesn't get much press. And then you have Hillary Clinton, which actually she even has an anti-establishment candidate, Bernie Sanders, who still hasn't dropped out of the race. I guess I wouldn't drop out either if the FBI was investigating the guy I was going up, or the gal I was going up against. But just knowing what you know and looking at all the data, do you think Trump is going to be able to take this thing all the way?
I do. Everyone who's in the race has, or at least the leading candidates have backgrounds that will always have something in them that people are going to harp upon. But where Trump seems to be immune to items in his past, there's a reason for that. And there's a reason for his popularity, and the reason for his knocking out the conventional establishment candidates, and also why Bernie Sanders did so well against Hillary, at least in the primaries. And that is, I think, for the first time in quite a while, number of people who are suffering in the economy, and basically suffering due to extraordinarily bad trade policies over the last couple of decades, where we've lost higher paying jobs and a lot of employment through bad trade deals. These are people that didn't see much of an alternative in prior elections, but with both Trump and Sanders, they did, and people were coming to vote who hadn't voted in a long time. I think you're having something of a populist revolution here that's very close to what you saw with Brexit, because in Britain they had the same problem. The economy's down, bad trade deals, a lot of parallel issues. And what it makes me think that maybe things are beginning to break here, particularly for Mr. Trump, because he seems to be the one that's going to go ahead with the Republican nomination, and presumably he's going to be going against Hillary. I'll tell you, I'm not traditionally a political analyst. I'll tell you up front that my political background is at least I consider myself to be an old line conservative Republican with a libertarian bent. I'm always open about my views, and I'll always tell you what I think really is going to happen. And I think what has happened here, and we're beginning to see signs, is that there's been a basic shift in the people who are coming out to vote, the people who've been disgruntled by the economy, that are going to probably put Trump over the top. And we may be seeing this. We saw yesterday a big jump in consumer confidence index put out by the Conference Board. Back in May, you saw a big jump there in the consumer sentiment measures out of the University of Michigan. the economic numbers are not positive. And you'll find that over time, most of those confidence readings and their movements can be explained by economic reporting in the press. The thing that was different here is that Trump became the presumptive Republican nominee in respect to these different prior to these big jumps in the confidence numbers. I'm not saying that's the reason behind it. That'll become obvious one way or the other as we go down the road. But I'm raising the issue that it might be an early indication that we're seeing a big shakeup in the system.
Last question, John. You've talked about hyperinflation. Do you still believe that is on the table? And if hyperinflation is on the table, what would that look like? What would that day look like? What would that week and month look like?
Well, my timing on that has been way off. I was looking for it back in 2014. On the other hand, the fundamentals are still in place. The U.S. economy, the U.S. Fiscal circumstance is one of long-term insolvency. If we get a change in government, one can hope there'll be some serious addressing not only of the trade issues that have hurt the economy so hard, but in terms of the fiscal condition, which is what threatens a long-term circumstance for the dollar. I hope there's enough time here for something to work. I don't know if something will work. The problems are very difficult to face politically because the system, as it was designed, worked well as long as you had big growth in the younger working population versus the retiring population. But now with the big surge in retirements, with the aging the baby boomers, the insolvencies of the programs such as Medicare and Social Security over time have become very difficult to try and work through. And the country right now, if the country with its existing obligations, what it's promising people in terms of their the various programs over time, if the country wanted to cover its obligations going forward, the money that it could effectively put in the bank, in terms of net present value, it would need in excess of $100 trillion. There's no way that can ever be covered. And that's at least not legitimately. When you have countries that get into that type of circumstance, particularly where basically only where the debt is denominated in the currency of the issuing country, which is the case here, the U.S. dollar. As Alan Greenspan once expressed it, no chance of the U.S. defaulting on its debt because it can always print the dollars it needs to pay it. Well, when that happens, that's when the dollar becomes worthless. We have enough dollars outside the country right now that is as long as people are bringing their money into the dollar, that's helping to keep things reasonably stable. But I think you're going to see not too far down the road a panic flight from the dollar, massive selling of the dollar, and that will actually begin to. The rest of the world doesn't want to hold the treasuries. China's pulling back from buying them. Japan, South Korea. The big buyer of the treasuries recently has been the U.S. Federal Reserve. And I think you're going to find the Fed comes back in as the economy continues to weaken here. The Fed very simply will reinstitute some form of quantitative easing where it buys the treasuries, because the U.S. Treasury is going to have problems selling those. Who's going to be buying them? The Fed can when the Fed was at the peak of its quantitative easing, it was effectively monetizing 75% of the new debt issuance of the U.S. government. It's still holding the treasuries that it bought. It didn't liquidate them. Mm-hmm. And the interest that the Fed earns on those treasuries, it gives back to the federal government. it's monetized the debt, and that's your printing of the currency, and that's what eventually gets you into the hyperinflation. But the rest of the world sees that, and they dump the dollar. It accelerates the process and can come to a head very quickly in the next year or so, without too much warning. But the key to it, thing to watch for, is a massive sell-off in the U.S. dollar.
John Williams of shadowstats.com. John, thank you so much. You've been very generous with your time. Always very informative. Listening to you, reading your letter. Thank you.
Thank you again for having me.